Welcome out to another Trading Justice podcast. This is Mark Justice, joined with my illustrious brother Matt, who almost nailed the Super Bowl prediction score to a T. I was very impressed by that. Also, going to be impressed when he talks about the four great technicians of market history. Yeah, later here in the podcast. I think this subject is just absolutely fascinating. When Matt first pitched it, I was like, yes, more of that. I just dive through history on what and how technical analysis formed. Just going to be a fascinating conversation with Matt on that. We're going to go through labor. We're going to go through the week that's coming up. We're going to examine the little bit of market volatility that came up in the market that was a little AI related in some software pockets. But really excited for the podcast today. Also excited for the upcoming AI Gold Rush webinar, Matt, that you are teaching next Tuesday,
Yeah,
February 17th. Matt, you really can't understand markets without understanding AI. And I think that is going to be true
no,
for the next,
ever.
like, rest of our lives.
Yeah.
Right, right.
At no point will we not have some degree of dealing with AI in some degree of capacity. If you think it's bad now, just wait for a year.
And what about 2 years and 5 years?
It's not going to stop. Like it's not
Like,
going to stop.
yeah, I mean, and we're gonna talk about AI throughout the podcast. But tell us about this upcoming webinar.
Yeah, I got a webinar coming up on February 17th. You can hit the link in the description under our YouTube and register for that at our live events page at Tackle Trading. The AI Gold Rush, I'm going to be focused on two things: teaching people what AI is all about in the market, talk about where we're at in the AI infrastructure build out, and we're going to talk quite a bit about software next week as well, and really kind of laser focus on finding the best software components, because unlike everything else in the market that is some degree of top end of the market conversation, the S&P 500 is at the top end of the market, Dow Jones is breaking out of the top of the market, Russell 2000, RSP, all at the top of the market. It's not at the top of the market right now, the NASDAQ. It's kind of a stone throw away from the top of the market, but it's a tale of two cities in the NASDAQ right now. And specifically on the AI trade, you have semiconductors that are holding firm very, very, very well, doing very good. And you have software, which has been absolutely atrocious, just absolutely atrocious. But you know what old Warren Buffett says, Mark, when the blood is in the street, that's where you want to buy.
Oh, Matt,
Well, to me, hold on, let me finish my point real quick. To me, it's not just when the market is down and there's blood in the street. It's when you're at a key level of support, you start to see patterns start to develop and their opportunities start to scream to you a little bit. And so I do think one of the biggest opportunities coming into the market this year is the software sell-off, and when that comes to some degree of conclusion here. At 115 3 months ago, the market was screaming valuation concern. The market at 80 on IGV, a little bit of a different conversation. So next week in the AI Gold Rush webinar, we're definitely going to be answering a few of those riddles in the market. Where are we at in the infrastructure build out? Obviously, go through the updated watch list and the tiers, but we're going to take a real quick spot check and highlight software opportunities coming from low points next week.
talk about a timely webinar. Absolutely fantastic. Looking forward to that. And Matt, let's go back to this.
And don't sleep on Master Trader. You can sign up for both, the same link. Just want to throw that out there.
Let's go back to that software chart, Matt, because there's been a lot of ink spilled over the last week. Markets had a little pocket of volatility. I'm going to ask for your broad market technical take here in a second, but there was a lot of ink spilled last week coming out of about just every corner of the financial universe on, software Armageddon, an
Yeah.
existential threat to software. You had JP Morgan, you had Goldman Sachs, you had Bank of America, you had Morgan Stanley, you had all the big banks attempting to try to explain from a non-technical perspective, and it might have just been a technical perspective,
Could have
how
been.
the fears of software that basically there would be a cannibalization through AI. AI was going to develop and is going to develop to a point where it puts software companies out of business because it cannibalizes their offerings.
Can I ask you a question?
Yes, of
on
course.
that because that is the argument from Wall
Yep.
Street recently, right? Is there's too much AI software, they're going to cannibalize. Oh, all right. What's one of the major companies in software that is putting more money in development into AI? It'd be
Microsoft.
Microsoft. So is Wall Street also equally suggesting that Microsoft is developing the technology that would destroy its own company?
No, they are not suggesting that for Microsoft.
But just for every other software component, even though Microsoft's doing the exact same as every other software component.
Yep.
That's where it loses me a little bit on the overall software's cannibalizing itself and whatnot. Well, explain Microsoft then. Explain Meta then recently. Explain some of the other companies that have not been participating. And so whether it was cannibalization or valuation or simply put, technically they just got too far out in front of their skis. I don't know what the ultimate answer to the causation of why software has had a massive pullback in the market, whereas the market has not had one. It would be one thing if the entire market was pulling back. It's not. The market is fighting breakout analysis right now out against all-time high status. And so software is in and of itself a unique conversation because it's doing everything opposite of what the market is doing. It's also the epicenter of the problem in the market right now. Without the downward pressure in software, you're probably talking about a rip-roaring bullish condition in the market right now. And so, like, I don't know if it was cannibalization. I don't know if it was AI got out in front of its skis. I don't know if it was the valuation conversation. What I do know is software is sitting at the 200 weekly moving average, and I'm extremely interested in any reversal conversation because I also believe that coming out of this downward pressure in price and software is going to be one of the bigger opportunities we are faced with this year.
Yeah, and Matt, can't a lot of the most recent in the last couple of weeks move down be explained from technical analysis? You break one support level, you go find the next support level. You broke that support
Mhm.
level in software, and did anything really change from that big picture over the last couple of weeks? No. But you got into open space and algos are faster than ever.
I think the
And
problem was Microsoft.
you know,
I think the problem was Microsoft. That's why I don't agree with the overall cannibalization of all software because in the last 2 weeks, you're really dealing with the Microsoft gap down from earnings 2 weeks ago where they had the miss on cloud. And so when they had the miss on cloud, they gapped down, sold down. And what happened is they was under any degree of pivot. You're also in a pocket on the longer term charts. And that just you just didn't have any support to stop the bleeding there until, quite frankly, Microsoft came to 400 and IGV came into that 200, not IGC, but IGV.
hey, IGC Pharma wants some love too.
Not today, it doesn't. But IGV came down into the 200. So ultimately, Mark, you can, in my estimation, you can write whatever you want in truly defining or trying to find the causation for the downward movement in price in software. Some of it was earnings. Some of it was some misses on earnings. Some of it was violation of support. I'm sure there's overhead concern. There was some of it part of valuation. Whatever those arguments that led to the downward pressure on price are, that I find those conversations interesting. I find those debates interesting. But what I find more importantly is not about understanding what was the specific causation of why price went down, because I don't think there's one reason, by the way. I think it's an environment issue more than anything. But that's different when you're talking about you breaking one support level. Let's go back just 3, 4 weeks ago. Once you broke 100, there was not a support level until
It
80.
just wasn't a
Like
support
they're
level.
just not a support level until 80 because of the aggressive response on coming out of the tariff induced correction we had last year. And so once you got underneath 100, there's just nothing there. And so I think you can describe last quarter and the downward pressure we had based on cannibalization. I think you could say is based on valuation. But I think once you got underneath 100 here, I think you're just blaming Microsoft and no support levels. Until when? until you got to
until you find a
8.
support level.
And now you're starting to find a support level. And so, yeah, I think the AI gold rush conversation is very important given the fact that we are starting to see the very, very, very early innings of perhaps something, some type of reversal here. It's early. We're still talking bearish with bearish momentum in software, but I have a lot of interest in bottoming formations here, Mark. And I feel like some of these software components are going to be some really good opportunities.
Yeah, no, and
Not
you know,
every
it's
one of them. Some of them will die coming out of this, Mark.
well,
They will.
that's the nature of the business cycle. Uh,
Exactly. But the ones that don't, shouldn't they stand out to you coming from the low point?
I think there is some baby in the bathwater analogies that are
Which
applicable
means
here.
you're going to want to check that AI gold rush next week because I take into account both fundamentals and growth and technicals when we go through that. But we'll have that conversation next week in the AI gold rush.
Fascinating conversation and certainly one applicable. Now, Matt, that's not really carrying over to many of the other areas of the market. We're seeing a pretty decent trading environment, technical breakouts in staples, technical breakouts in industrials. The broad market as measured by the cap, heavy tech. Do you think it is just a tech issue that is just weighing down the market because of the market cap? Because we are seeing breakouts in other areas of the market.
Not only are you seeing breakouts, Mark, but you're seeing momentum conditions in other areas of the market. One thing we do every single week in the Tackle Trade newsletters, we rank all of the different sectors. And if you read the newsletter over the weekend, I know you did. I know you answer. You're just throwing me out a softball question there, but
Yes.
yeah, I would absolutely say it's a tech problem, but I wouldn't even say just tech. I think it's a Max 7 problem right now. I think it's a Max 7 problem, and everything else is looking a little bit better. And so last week we downgraded technology. It's the lowest rated area of the market right now for us. Discretionary and communications also got downgrades last week. Well, whereas most people over the weekend and over the last week and a half has been talking some degree of end of the world type stuff is what we're seeing on social media. That tells you where everybody in social media is. That tells you that they're all in software AI trades and they're all in Bitcoin or other crypto relatable assets, or they got caught up in the silver and the gold volatility. That's where all the complaints are in the marketplace. And so if all of your social media feed is that, that's where the highest positioning of every trade was in those areas of the market. Well, some of the forgotten areas of the market that we never forget at Tackle Trading is the cyclical side of the equation.
And we never
Um,
forget them because we're a
we love
community
them.
of traders, right?
Yeah.
And a good trade can pop up in any area, and it's
We don't need your Twitter buddies to jump on your favorite software trade to get involved down the industrial side of the equation. No, we do not. Industrials, for example, is the most consistent area of the market right now. It's followed very closely by energy and basic materials. Those are the three highest rated sectors. And not only the three highest rated sectors, they're a good 15, 20 points in front of what we're seeing on the aggressive side of the equation. And the one sector out of the cyclical that has not been great recently is finance, and they're developing into a pretty decent pattern in general. But yeah, the aggressive sectors have been a little bit of the problem. That's why the S&P 500 is in broad-based consolidation right now, whereas RSP, which reflects a little bit more of the QE trade. Remember, I discussed this. When you're looking at the ES and the NQ, you're really looking at the AI trade. When you look at RSP, you're really looking at the QE trade, is basically how I look at them. And RSP had a wonderful breakout on last week on Friday, seeing a little bit of continuation development here today, looking pretty good across the board. And when RSP is looking really good across the board, you know you're having a cyclical moment. And so the best sectors out there that have been trending would be industrials, basic materials. You got to throw energy into that, and you got to throw consumer staples into that. And so, yeah, the problem in the market right now is I don't want to just say aggressive because take discretionary, for example. There's a lot of good setups in discretionary right now. You know, it's not a good setup, the
Amazon.
discretionary space right now, because it's really reflecting Amazon and Tesla. And so you come over here to communications, and there is really good bottoming formations happening in communications right now. You know what hasn't been great in comms was the responses to Google's earnings and the response to Meta's earnings. And so those two are certainly playing a role in the downgrades on the aggressive side of the equation. And I don't have a negative opinion of Google or Meta. Like I thought both of them had stellar earnings, but the space is going to be impacted because they're juggernauts to the space. And so the aggressive sectors, I would say, are a stock picker's market. I legitimately would say that. I don't think you're getting a tailwind. I don't think you're getting a headwind. I think it's a stock picker's market in the aggressive sectors, and I think you're getting some pretty decent love coming out of the cyclicals.
Yeah, no, and this stock picker market is one that we're helping our pro community navigate well. And while we're navigating the technicals, which, really have been holding up, like, if an area has been strong and it's given good technical signals, they've given it up. Is keeping an eye on that fundamental backdrop to see if any narratives have changed. We'll talk about Kevin Warsh, make fun of that in a moment, but first I want to get an earnings update from you, Matt.
Mhm.
Like we have chronicled on this podcast for what seems like years now, the foundation of this bull market has been earnings.
And
We're
it's
about
still
it,
going to be, by the way.
and well, and there's your spoiler right there.
I just wanted to get it off right there.
you
Still
know, you know. But what are some of the takeaways you have from this earnings season as we come to a close?
amazingly, I can't point to one catalyst stock in this earnings season so far. I can point to some banger earnings reports, some awesome technical setups, secondary setups, you name it, right? But I can't point to one stock in the earnings season so far that has been like, oh my goodness, you got to look at this space right this very second. And so it's been one of those earnings season where catalyst, and that might be one of the reasons why, Max Evans is the problem right now and not everything else in the market. Breath is doing pretty good right now, is because those they didn't provide a catalyst to the market. Coca-Cola doesn't provide a catalyst to the market. Not even Walmart, the juggernaut Walmart, they don't provide a catalyst to the market. AMD, Micron, Nvidia, Broadcom, Google, Meta, Microsoft, Amazon, they provide catalysts. They're big. They have broad shoulders. They can carry a lot of weight in the S&P 500. But so even though I can't point to like one catalyst stock that was just like the end all easy catalyst in the market, the environment in earnings is really stellar, quite frankly. What did I tell you last week, Mark, that we're probably going to get into 13% this week on EPS blended growth rate, and that's exactly where we got. The last 2 weeks of EPS blended growth has been lights out. It's been awesome. You went from, I mean, for the first 3 weeks of earnings season, you basically flatlined between 8 and 8.2. Right when we started getting into those big dog Max 7 components, all of a sudden, blended growth jumped to 11.8, 11.9 last week, jumped to 13 this week. We're probably going to inch up to about 14 by the end of season. And if you start at 8 and you finish at 14, you got to call that a pretty good season, quite frankly. And so I'd give it a B this quarter so far. And you know me, Mark, I'm very aggressive on my rankings. Like I don't give A's. Like you got to be standout. So why not the B plus? Why not the A minus? If EPS blended growth is so good, and it is so good. But it's not just EPS blended growth, by the way. Revenue is actually doing pretty good. Revenue's at 8.8% on its blended growth rate. That's fantastic. Uh, Average revenue beat rate is above the 5-year average at 1.3%, and average beat is at 64%, which matches the last 5 and 10 year high. But recently, in the last few quarters, low 60s was good enough. So revenue EPS, like on the macro side of the equation, there's just no question here. Like they're perfectly fine. So why the B and not the B plus, not the A minus? Themes, easy to understand earnings themes provided by stocks that the entire market fixates on. like there wasn't an easy catalyst theme. Like you can't point to one earnings out of the Mag 7 and be like, ooh, 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 that one, that one. Like beautiful things are happening. All good, all beats, all with all, a little bit less beats than what we saw last quarter, but all of them very good. But I wouldn't describe them as a catalyst. And so I'd have to come off that high grade in earnings season for so far, but a B, good enough. And I think moving out of this earnings season, regardless of what happens next, like you can't blame earnings. It's not an
And
earnings
it's been
problem.
so, I can't understate because we've had pockets of volatility
Mhm.
off and on for months and months and months,
But why
and we
haven't you and I got ultra bearish like
the reason because
earnings?
of earnings,
Mhm.
right?
Hard
And
to see
so
sustainable bearish trends with this earnings environment.
it just is. It just
Couple
is,
that with a
right?
GDP environment north of 4%. Yeah, it's hard.
Yeah. And the AI productivity helping companies, forward looking, right, continues to serve as that foundation for bulls and continues to serve as the foundation for the bull market, And so you're keeping an eye on, and I want to switch to gold now, unless there's any individual earning companies that you wanted to highlight.
This week,
Yeah.
no, like I said, there's 77 companies out there this week. If you had to say, we're recording this on a Monday, so just thinking about tomorrow, I don't think there's anything tonight that is interesting. Tomorrow you get Coca-Cola, CVS. Tomorrow night, Robinhood, that's an interesting one. Ford is an interesting one. Cloudflare is an interesting one on Tuesday night. On Wednesday morning, I would have to say McDonald's, and T-Mobile. Shopify Wednesday night, App Love and Cisco. Thursday morning, probably Crocs. Thursday night, definitely Coinbase, JFrog
So
Toast.
interesting names throughout the
That
week.
all very interesting names. Like there are some very interesting names on Thursday night, for example. Coinbase, JFrog Toast, DraftKings, Applied Materials. That's a very important night. But are any one of those catalysts for the S&P 500?
No, they are not.
Or is there anything on the board this week that's a catalyst for the S&P 500?
No, not for the S&P 500.
No. So like Dexcom, Toast, Pins, AR out of the Tackle 25, ANET, Virtue, Net, DDOG out of AI Gold Rush, DSM has Oscar in the financial healthcare space. So like very interesting names, important names to certain trades in the market and industries, but no major market movers. The one thing I would suggest is a major data point this week is the economic side of the equation, Mark. What's your thoughts on the economic landscape?
Well, the economic landscape, because once again, when you have like bullish foundations, right, you're always looking at things that can derail that from a market analyst perspective. What can derail it, right?
Mhm.
One of the, and when you look at the economic calendar this week, can a hot CPI report derail it? Probably not, right? You usually need multiple inflationary reports to come off because even if you have one hot one, Matt, what does well, it's just one data point, right?
I think CPI is set up to be a nothing burger this week.
Nothing burger. But Matt, there are,
There's a
I think,
reason for that, by the way.
but the labor market is a different story, right?
Mhm.
You know, one of the great potential, and we talked about this in the dark clouds kind of hanging over the market
Mhm.
that could develop is a labor driven recession where labor market implodes or is greatly reduced due to AI. And, you can't understate
Is that a
the,
dark cloud or is that just truth? Like, because I just see that as truth. Like, all of what
and
you just said, I'm going to guarantee happens in the labor market over the next 2 to 3 years. So, like, I don't see that as a hypothetical. I don't see that as a dark cloud. I see that as an absolute guarantee to occur over the next 2 to 3 years.
yeah, no, and you've detailed and talked about AI's impact on the labor market numerous times in this podcast.
Mhm.
You're very vocal right there, and
I'll talk about it next week too.
and this is something that can the market absorb that over time? That's a
Yeah.
question, and
Yeah, of course the market can absorb that over time. I mean, The reality is, like, AI will take jobs. AI will create jobs, but there's going to be a massive disruption in between now and then. And as such, a lot of concern historically would be, well, if people don't have a job, GDP comes down, spending comes down, retail sales comes down, everything comes down, right? Well, you know what doesn't come down due to AI? Taking jobs, profit margins. That doesn't come down. That actually goes up. The highest cost to deliver a service or a product in the market is the labor impact. And so if companies can figure out how to maintain production, services, quality without the overhead, those companies' revenues don't have to come down. And if their revenues don't come down, neither does their price. And so, to me, the labor saga is a fascinating one in the marketplace. But personally, I see the AI labor market conversation. I see this as a general human interest, not just a market conversation. From a market perspective, if you were gonna, if 10 years ago you were to ask me, Matt, do you think labor is going to implode over the next 2 to 3 years? I would, if the answer would have been yes, the follow-up would be, well, what does the market do in that capacity? And I'd say the market's down 20 to 30% in that capacity. I don't have that opinion any longer because AI certainly takes from one side of the equation, but it gives to the other side of the equation, and they offset one another. So I'm not sure how big the AI labor story is to the financial world. I think it's absolutely massive to our society in general, because our market is getting to the point where it's a K trade, much like our economy, where it's leaving behind 50 to 60% of Americans. And so I see that more as a general human interest and societal problem that we need to focus on as a nation and hold our government officials to account when it comes to the conversations they're having right now. Because they're not talking about this, and this is coming. It's not just coming; it's already here.
Oh, they're
Um,
talking about it. They're just not talking about it. Like Kevin Hassett today was talking about, like, hey, you might see some lower numbers in the coming report, but he didn't point to the causal reason for it, did he?
I don't know. I didn't listen to Kevin Hassett. Next time, pull up the video. We'll play it.
Okay.
But I will say Kevin Hassett usually leaves out a lot of the very important points.
Do you think our government officials, I mean, this isn't a market question, this is the human interest. Do you think they're aware of the problem, or do you think they're a little bit slow to it because of politics or whatever reason?
I don't think they're on top of this issue. No,
Yeah. I worry
I,
that
their their strategy is to flood the zone, and that strategy is not one to fix systematic issues.
now, well, and so labor market on Wednesday,
I don't
uh,
think our government is focused on fixing anything that is difficult to fix.
that is, I think you're going to get a
I
lot of people
cannot
that are
give
going to
a
nod their
listen.
heads on that one.
I'm not happy with anybody in our government. I'm not happy with the focus on our government's focus is on right now. I think we're missing the beat. I think we're missing a moment, and it's concerning, and it's not going to become concerning to them until it smacks them in the face. So, to me, we're already behind on the AI infrastructure build out conversation, specifically as it pertains to the people that infrastructure build out's going to leave behind, which is about, in my estimation, 60 to 70% of the consumer base in the US.
That is that's fascinating. That Oh my goodness. Sorry for the pause. I had a technical problem. Can profit margins maintain themselves in a changing society? And your strongest take there, and I keep thinking about it to try to play the rebuttal, right? That if consumers, lose their jobs, if we have a labor market, driven, but could there be a recession and the companies still hold their margins, do you think?
Yeah, I think we've had many rolling recessions for the last 5 years. So yes,
Yeah,
yes.
I mean, that's such a bullish foundation, Matt, when you think about
Profit
it.
margin expansion is very bullish.
Like extremely bullish.
Yeah. Just
And
wait
one
till they launch UBI after the disruption.
Yeah, and what might one finally argue after a week of market turmoil of false narratives? Kevin Warsh is likely to be, let's look at the gold chart while we talk about this. Kevin Warsh is likely to be bullish as well, isn't he? Right? We had that market volatility last time we did a podcast. We were just coming out of a pocket of volatility on
Mhm.
gold and silver. That seems to be easing up. And Matt, I saw a million articles on Kevin Warsh's impact of the market, and I'm not seeing any in the last 4 or 5 days. As Wall Street came to the reality check that we talked about in the newsletter, that the Kevin
Well, if they
Warsh.
listened to anything I put out there in the last 10 days, they did. Kevin Warsh is not the hawk that Wall Street tried to paint him as. I said this last week in the pod, I'll say it this week.
This is one you nailed right
Anybody
from the
that is, hold
start.
on, anybody that is using 12-year-old data to justify a opinion of today, like they kind of missed the evolution of our political system 10 years ago. And so Kevin Warsh, the epicenter of the hawkish philosophy of Kevin Warsh is he gave an interview where he basically discussed leaving the central bank due to his disagreements with quantitative easing too. And he thought quantitative easing one was fantastic. It was a gamble, but it worked out. But he felt like they were just pressing it a little too much going into quantitative easing two. Now, in this interview, it was after he left the Fed, and he used that as a justification for leaving the Fed. I'm going to call bullshit on that one. I don't believe that to be in any capacity that you love QE1, but you were so adamantly opposed against QE2. I remember those days. I remember Ben Bernanke before 2012 coming out in a united front. I remember Janet Yellen after that in a united front. I didn't see Kevin Warsh putting up a billion arguments against how dovish the Fed was back then. And so he gave an interview where he basically talked about how he was opposed to QE. Mark, how many different political officials, and I would say Kevin Warsh is a political official, how many different political officials said something negative about Donald Trump before 2016? And how many of those officials today still maintain that negative statement that they said before
There's
2016?
been a lot of flip-flopping,
And,
brother.
and I'm not going to list them out, but the
And
vice
a
president.
lot of flip-flopping on the
Uh,
subject.
Graham was one of them. Like there was a lot of them.
A
Marco
lot.
Rubio was one of them. I remember Marco Rubio in those political debates and those his little stump speeches. I remember Ted Cruz. I remember all of these dudes. And you know what they don't say now? Anything like that. Anything. And all of a sudden, Wall Street's going to want to make us believe that Kevin Warsh is the same dude in 26 that he was in 12. Seriously? By the way, did you also equally see over the weekend that Kevin Warsh, the nominee to run the central bank, is already negotiating with Besant, who runs the Treasury, on combining their QE?
Now, anyone who thinks that they are just starting negotiation, or if this thing hasn't been brewing
There's no
for
negotiation. This was
this thing,
discussed and agreed upon before he was even nominated.
yes, right? Handing over more power for the Treasury to control things,
Anybody who
to
doesn't
boost liquidity, right?
listen, if you
like
believe Kevin Warsh did not agree with Donald Trump on rate cuts before he got nominated, I got some. Let's go to Mars.
I
Let's
mean,
go.
and once again, we're a week later, but on the Sunday Future Open that we have for our promo community 2 weeks ago, after the volatility of Bitcoin and gold over the weekend, and on this podcast last week, and in conversations, we're like, that's a dead narrative. Whether or not Wall Street realizes it's a dead narrative, that's a dead narrative,
It
and
took Wall Street 15 years to get on the gold stock freight train. Let's not give them too much credit where they don't need it.
yeah,
They might never figure that one out. They might say Kevin Warsh is hawkish just because somebody else told them that. We got to stop thinking Wall Street is smarter than the rest of you.
that's true.
They're not.
But there's zero chance Kevin Warsh does a net result that is not market friendly. That is not liquidity friendly. That is not keeping the engine
The two
chugging
main
friendly.
points against Kevin Walsh are he's going to reduce the balance sheet and he's not going to embrace QE. Do you think there's any chance of those two things occurring, that he doesn't embrace QE and he doesn't and he reduces the balance sheet?
No, even if the
There's no way.
coordinated effort, the net result, even if the Fed has less on theirs and the Treasury has more on theirs,
The
right?
market will punish him in a heartbeat and he'll never do it again.
Yeah, no. So
And I don't.
Marsh,
Yeah.
that's a dead narrative, Matt. It's a good look for gold.
I think a lot of people who complain about old Jay Powell might be wishing they had some Jay Powell in about a year from now.
But gold, good look. All the foundations are there, right? And that's one of the things of this recent volatility. As we emerge from it, right, the narratives that kind of drove it are dissipating. Earnings remain strong. The wash dissipating. Like, uh, you know, software at support after the sell-off, right? It's not a bad trader's backdrop right now, is it?
I think it's a pretty good trader's backdrop, honestly. But I always think it's a good trader's backdrop. I mean, is it an easy trader's backdrop is the ultimate question. For gold, it's getting there. I like the reduction of volatility. It's been quite pronounced, quite frankly. And I think you would assume that we've seen the same reduction in volatility in silver that we have in gold, but we haven't. And that's the key point here, in my opinion. I like gold. I like gold from a technical perspective. I like gold from a long-term perspective. How you tactically play this, get into our traders lounge and let's have the conversation. But on silver, I have not seen a reduction in volatility on silver yet. And I think that's one of the things that absolutely has to happen. Margins are still really, really, really big right now. Margins are still expanding in silver. You're dealing with silver with over 100% implied volatility on the short month. You go out to SLV. SLV is dealing with 80 to 90% volatility for literally months out on implied volatility. You look at the same thing on gold and you're talking about a walk in the park around 30 to
Yeah, it's
40.
really
Like
died down.
like gold has died down there.
Yeah.
As the development of the pattern was just a little bit better on gold in my estimation on silver than silver. Silver still has work to do. Silver still has work to do, both in terms of the overall development of its pattern, as well as the reduction of volatility. Once volatility hits the market, you never know the truth of the market until that volatility declines. And as that volatility declined in gold, gold got a bid. As that volatility has not declined in silver, we're still seeing a pretty radical up and down nature of silver. And so the only thing I would say on silver versus gold right now is we're still in the trenches on silver. Looks to be smoothing out on gold a little bit.
Yeah, and that reduction of volatility in gold is for me and from a cross asset perspective, really, really healthy, right?
Yeah.
Really, really healthy, because we can see assets that get volatile and it bleed over into other assets, right? That's not uncommon. And so when you start to see in some of the assets that were volatile for a minute die down, and there's the day trader in you that just is like that level is dialed.
The 5113 level is so sexy, so sexy. And by the time you guys watch this podcast, it might already be done. But I am looking forward to the Asian market tonight.
Well, good deal. Listen, and one of the things that he'll put his skill set to use in the Asian market is his technical skill set, and we're going to do
Mhm.
a very special feature presentation right now,
Mhm.
in which we are going to highlight some of the great technicians of all time. I thought that this would, when Matt pitched the idea of like, him wanting to do something along these lines, I was like, it's such a fascinating topic, right? Just to look back from a historical perspective, kind of understand who quietly built modern technical analysis, right? Before charts and indicators and platforms and the modern era that we live in, right? Oftentimes there were just questions, right? And so Matt has put together what he is calling the Mount Rushmore of technical analysis. What was the idea behind this, Matt? On the Mount Rushmore of technical analysis.
Well, it's the Mount Rushmore of technicians.
Of technicians. Yes.
And the fathers, like our founding fathers of the great United States of America, right? Like when you think about our founding fathers, Mark, who comes to mind first?
For
Like you,
George Washington,
George
Abraham
Washington.
Lincoln, right?
Abraham wasn't a founder. Come on.
Okay.
Founders.
Thomas Jefferson,
Thank you.
James
Thank
Madison,
you.
George
Thank
Washington,
you. All
John
those
Adams.
all those big bad boys, right? By the way, do you have a favorite founder?
I having watched the HBO, I think it was special on John Adams. I find his character very, very interesting. Like from just a
John,
person,
that was a good show. You should watch it. It's a
like
good
just
show.
like if
Yeah.
you haven't seen it and you like politics and history, it was a really well done show. And I
John
found
Adams
his
was
like
fantastic.
so. But I'm a
I'm
Thomas
gonna have to
Jeff.
go with TJ,
I'm a
Thomas
Thomas
Jefferson.
Jefferson
I'm a
as the
TJ guy,
yeah.
for a variety of different reasons. Obviously, author of the Declaration, but um, honestly, he made the greatest trade in U.S. history. um, was it 10 million for the Louisiana Purchase that tripled our size,
It was a
basically?
good deal.
That was the greatest trade in U.S. history. So he was one of the great traders. But no, Mark, I honestly I give a lot of thought to the historical nature of something. Um, and one night I was just kind of thinking, I was scrolling through Twitter, as I often do. And I was just, Twitter was discussing, debating something, and, the Mount Rushmore of NBA greats, the Mount Rushmore of NFL quarterbacks. And I was thinking, I just got done teaching a class, and I was thinking, what about the Mount Rushmore of technicians?
Okay.
And then that led me to think about who created all of this originally? Like everything that, I teach and talk about and base everything off of, where did those ideas come from? And understanding, and you know me, I like to understand the historical, not only the historical path of something, but the story. I get into the story of that. And so I started just thinking about the four core great technicians who all brought something different to the technical story. How you read technicals today, you versus me versus everybody that's listening to this, we look through the lens of trends and patterns and support and resistance. And, when I'm talking to a bunch of swing traders, we talk about ATRs and pay ranges and targeting techniques. And, then I'll talk to other technicians who love Fibonacci analysis and Elliott wave. And I'm thinking, where did all of this come from? Did Elliott wave, did Elliott have such a vitally different philosophy than Charles Dow or to Richard Wyckoff or or Gann, right? They all brought something different, and so I like it's not like Dow created the original theory and then each one of these technicians built upon that original Dow theory. They all brought something unique to the picture that helps us navigate technical analysis today.
Now,
And
just a general question, because I mean, one of the reasons I find this so interesting is because you know so much about it. I don't know very much about these gentlemen, but were there like a problem they were trying to solve, or was it
I
general
don't know if there was a
curiosity?
problem. See, that's the thing. Like maybe after
Because
Dow.
like when you think of scientists, you think, oh, they want to solve the problem.
Okay.
They did.
So after Dow, maybe. If that in fact, probably yes, after Dow. But before Dow, I would say no.
Okay.
Because Dow was just trying to understand one simple concept. Is the market chaos or is there a consistency to it? Is it chaos or does the market trend? That was the question that Charles Dow tried to answer. So I do believe that Dow was searching for an answer. Yes, like in general, the question was, is it chaos or is it consistency? Right? Is it random or is it predictable? Right? That's what I think Dow was trying to do. And when Dow first brought to the table was that the market clearly trends, that it's not chaos,
That it's not random.
that it's not random, that there's a trending probable factor here. And what he studied was the time frames of trends, that there are certain time frames that things trend. And that they certainly don't go in a straight line, but Dow wasn't trying to answer anything other than do they trend or is there chaos? And so what Dow brought to the table was he gave us the existence of trending analysis in general, and then the structure of the time frames for how we trade those trends. For example, the first class I ever took on technical analysis was a class taught by Legacy Education back in October of 2005, and it was taught by a guy by the name of Mike Batty. And I'll always remember Mike because I love Mike, number one. And number two, Mike was just this old cowboy from Utah. Like he got his cowboy boots, he talks like a cowboy, he got a cowboy hat, and I instantly loved Mike. Like I just instantly loved Mike. I loved how he taught, loved his analogies. And Mike in that class taught me, hey guys, in trend analysis, he didn't mention Charles Dow, by the way. He just said in trend analysis, we deal with short-term trends, intermediate trends, and primary trends. And if you were to call up one of the great technicians I've ever known in Noah Davidson, who reauthored that same class Master Trader just a few years later, Noah would say, "Hey Matt, if you asked him just one simple question, how many directions of trends are there?" And he would say three: up, down, sideways. And then the second question you would ask him is, "Well, what are the lengths of trends?" And he would say three: short, intermediate, primary, because that's Dow. Dow brought that structure, and that hasn't changed ever since then. Now, that's all he brought is the structure of chaos versus consistency. That there is a trending philosophy, and these trends have a logic to them, have a consistency to them. And so when you look at, say, the ES right now on the short-term side of the equation, you're neutral. The ES on the intermediate side of the equation, well, that's turning, it's still bullish, but it's starting to show slowing momentum. The trend on the longer term is still rip-roaring bullish. And so how you trade is going to be based on the time frame of what you're looking at. And that's what Dow really kind of brought to the forefront. But what Dow didn't have an understanding about is what creates the trend in the first place. Now, Dow said
So
things
so
trend,
Dow was
but he
just
didn't answer why it is
so Dow
created.
was just that they exist.
They exist. Yeah,
That they exist.
that they
Like this
exist.
isn't random,
Well,
they
again,
exist.
we're talking in 2026. This is not a question, but when Dow was talking about it, it was an open question in our society. Because, Mark, it's not like people have access to all these fancy
Matt,
computers
I
and whatnot.
guarantee you there are many individuals without knowledge where it's still an open question to them. That where they say the
I'm
technical
sorry for them,
analysis.
but that answer was provided over 100 years ago.
I think there's a lot of people are like, well, they're just lines on the chart, right? The skeptics that you hear of technical analysis.
Yeah, because the skeptics don't understand that these dudes after Dow didn't just answer pure technical situations. They were looking at behavioral analysis. That's what creates the trend. See, Dow didn't have a philosophy of what created the trend, but Wyckoff certainly did. And after Wyckoff came out and started talking differently, guess who else did? Elliott did, try to answer different behavioral analysis, and then Gann brought pay ranges and behavioral analysis to the conversation. So, yeah, I get it. For the non-technician who just thinks in magic lines and chaos theory, that's fine. You go be you. Like I'm not trying to change you. Because if you still after 125 years still believe in chaos theory, and not behavioral analysis based on human nature, like I can't help that dude because that dude that answer was provided over a century ago, and that hasn't really changed.
Yeah, it's just fascinating. I mean, first of all, Dow's beard belongs on the Mount Rushmore of beards. That is a fantastic beard.
He looks
But
like a Civil War general as well.
all
Uh,
right, so Dow's place just in the discovery of trends and the
yeah,
proving. I mean, that I
the
can
proving it
understand why.
wasn't random.
That
Because
alone.
if in your mind, Mark, and you're just a normal dude in society, and everybody around you is like everything's just chaotic, it's just chaos, it's random, you're not going to want to be involved in anything. You hear the word chaos, and all of a sudden you want to do things. Like that's not most people. And so
No.
Dow answered something that was legitimately a vitally important question. Is it chaos? Is it random? Or is it consistent? And he provided that answer from a consistency perspective.
All right. The next gentleman on your list, right? Mr. Richard Wyckoff, right?
Why, and by the way, all of these are called theory, Dow theory, Wyckoff theory, Elliott wave theory, because it was new at the time. They're not really theories anymore, but it was new at the time. And over time they have been, proven to a certain extent, but they were called theories at the time. Now, what Wyckoff brought to the table was if Dow brought the existence of trends, Wyckoff wanted to understand why they were created in the first place. If there is an existence of a trend, how do I spot the beginning of it? How do I
Okay.
spot the ending of it? That's what Wyckoff was trying to understand, the beginning and the end nature of a trend. Now, what Wyckoff also helped us provide, though, is the early understanding of behavioral analysis within the backdrop of the technical conversation. And so when you talk about Wyckoff, he provided three laws, the Wyckoff three laws. Number one, supply and demand drive all price action. It's not random. Supply and demand, people's decisions drive price action. Number two, cause and effect links base building to future moves. That is behavioral analysis. 1000%. Identifying historical patterns that have a tendency to repeat themselves, that's based on human nature. It's not based on the rent. See, this is where technicians or people who rip on technicals get it wrong. They just look at the technicals. Oh, you're just talking about some random candle and random resistance. So, what creates that environment? What creates the momentum? What creates the lack of momentum? And so, cause and effect is kind of that first study. Gann kind of propelled, kind of took this and ran with it a little bit, but it was the first kind of study of behavioral analysis within the backdrop of the causation of price action in general. And then the third one was effort versus result, which allows us to have an understanding of the if a move in the market is real or if it's fake. And so I'll just look at two of those very quickly. Effort versus result goes to the size of the candle and the size of the volume. If you have a big candle with big volume, Wyckoff would say that's real. If you have a big candle with small volume, Wyckoff would say that's fake. And so tying volume to candlestick analysis was
Which makes
really
sense
powerful.
if the kind of if the base of his theory is supply and demand,
Yeah.
right? It
But
makes
because if
sense.
three dudes buy and all of a sudden you got a big candle and it's like, oh, well, that's just three dudes buying. Like,
All right, that makes sense. That makes
yeah.
sense.
Okay. But I think where it really took off, and we can get into Wyckoff. Like I could do a podcast just on Wyckoff. I could do a podcast just on Elliott. Like, not a bad conversation, by the way, if we just want to spotlight some of these guys. But the cause and effect is what really stands out to me on Wyckoff. Not just the accumulation distribution cycle, but the cause and effect. What it linked was the base building to the next move, which is behavioral analysis. How far something will run before it gets tired isn't based on an algorithm. It's not based on anything other than how we human beings participate in how we make decisions when it comes to money and risk and loss and return and all of that jazz. And so cause and effect was the first time we really saw some degree of behavioral analysis to help us answer the ultimate questions of is there a rhythm behind pattern development? And then in the starting of trends, like I said, I'm not going to go into it in detail here today. I'm not going to teach the accumulation distribution model, but that's what he answered in the beginning in why trends begin versus why trends end, is there is a cycle to it. So once again, you go back to Dow. Dow says there's a trend. Wyckoff says, well, there's not only a trend, but there is a cycle to that trend. And if you can understand the cycle, you can now start to participating in it at a much, much greater level. And by the way, these dudes were talking over 100 years ago. I'm telling you right now, that's not a different conversation today. It's a very, very, very similar conversation today. What Wyckoff did not answer, though, and a very important part of trending analysis is time frame. Um, like Dow talked about short, intermediate, primary. What I'm talking about here is the amount of time within a pattern, the amount of time within a trend. How many candlesticks? For example, Mark, how many times on silver before the recent volatility, after a 4 to 5 day move in silver, did I tell the community we have to sit back? We got to
You
stand down,
you did numerous times, and then you pointed to the
including the day before the volatility hit last week.
Yep, and you pointed to the historical pattern that had been exhibited of the certain days moves up in the existing trend that we had. You did it for our community numerous times.
See, Wyckoff didn't answer that. Dow didn't answer that. You know who answered that? The combination of Elliott and Gann answered
Okay.
that. And so what Wyckoff didn't provide is the ultimate time frame analysis within patterns and within trends in general. And that's where you have to understand the next two gentlemen. Ralph Nelson Elliott, famous for Elliott wave, obviously Fibonacci's, Fibonacci extensions, Fibonacci wave counting, the beginning of trends, the ending of trends, the momentum condition within the backdrop of a trend. Like I'm a big fan of Elliott. I'm a big fan of all four of these giants, and I get a little heartburn when people start making fun of Elliott Wave and Fibonacci, and it's like, oh, once again, magic lines. You don't even know what he wrote about. You don't even know the theory. You don't know the thesis. You don't understand the behavioral analysis, and you just make assumptions based on price action. It means you shouldn't be a trader in the first place, let alone understand these greats and what they brought to the technical conversation. What Elliot was searching for was how does the trend, from the beginning of the trend to the end of the trend, what is the average cycle? What does it actually look like? So Wyckoff said there's a cycle to all of this. Dow said there's a trend to all of this. Elliot tried to answer the timing of the complete picture. And he did it through wave counting, ABC cycles, Fibonacci. I mean, you name it, right? That's what his technical contribution was. And by the way, people might not say wave three, wave four, wave five, but they still break down the entire analysis the exact same way Elliott did. And so Elliott explains how trends progress through the wave counting. So are you at the beginning of a trend? Are you at the ending of a trend? What's the momentum condition? How far of a pullback are we going to expect here in the beginning point of ABC cycle? By the way, I think the number one way to navigate market corrections in the year of our Lord 2026 is an understanding of ABC cycles that Elliot wrote about 100 years ago. Truly, I think it's the absolute best way to navigate market corrections is through the ABC cycle. Now, what he didn't explain is the exact timing element to how long something lasts within a pattern. And that's where Gann excelled, like absolutely excelled, brought it all together, took what Elliot was talking about. And again, it's not like these dudes all talked to one another and tried to help one another. No, they were all trying to answer different questions, but they all built upon one another. And what Gann brought to the table was he looked at this specific structure in those waves in Elliott Wave. I'm not saying he used that same terminology, but he would look at it from okay, the same way like Mark I would. Like, okay, on silver has a trend of 6 points in 5 days. Okay. That's potential average yield. Potential average yield is the combination of Elliott Wave and Gann with a little bit of Wyckoff cause and effect base building. But that's what potential average yield is. Potential average yield is the number one targeting technique that I teach at Tackle Trading. It's, in my estimation, far more accurate than Fibonacci is, but I still like Fibonacci. It's just, it takes into the combination of the benefits of all of these people. And what
And
Gann
and
did,
in common language for maybe individuals that don't know what pay is, potential average yield, it's just the measurement of the expected move, right?
yeah,
How far you
how much time
expect.
and price to expect in overall patterns. Yeah.
Yes.
You can do it in pattern development. You can do it in wave counting. Like either one is perfectly fine, but they are different, right? Elliott did it within trends. Wyckoff did it in bases. Gann kind of put it together. What I was taught how to do is take it to that next level in terms of understanding potential average yield, both time and price within the construct of specific pattern development. And so, yeah, I don't see the market outside. How many times you've heard me say I do not see technicals outside of behavioral analysis? That's because none of these technicians, none of them, none of the great technicians saw technical analysis purely through the form of a candlestick, purely through the form of a name of something. They all look to find the repeatable patterns, the repeatable logic, the repeatable concepts that have a tendency to repeat themselves over and over and over.
And so from a comment and just listening to this, basically, if something is repeatable, there's something behind it, and they were trying to analyze
It's
what's
system,
behind.
well, if something is repeatable, you can create systems to take advantage of it. That's what cycles in the market are all about, a repeatable pattern that we understand and we can take advantage of. And at the end of the day, price action is not magic lines. Price action is the epicenter of price action is the decisions you and I make over price. That's where you, if you want to master technicals, master human nature. That's what these four greats did. They mastered human nature and thus understood how to master technical analysis. You can't see if somebody only understands the naming right of technical analysis and how to spot it on a chart. Yeah, you're a technician, but you're not taking advantage of what true technical analysis is. Technical analysis takes into account how we make decisions. The initial creation of a candlestick is based on decisions you and I are making. And so what these greats try to do is try to understand the patterns that created all of it. Every part of that conversation, technically, that you and I have with our community and every other community out there, well, guess what? They all found their foundational principles in one of these four technical giants. And so, yeah, they're all technical giants, all great educators. They all brought something bigger to the conversation. And I don't think, like, I'm not an Elliott wave technician. I'm not a Gann technician. I'm not a Dow technician. I'm a technician who tries to understand the technical condition the same way these greats did. Try to understand the meaning behind the technical analysis. And if you can do that, then you get in front of everybody else in the market. And so Gann brought that there was a consistency in time and price within the development of patterns, which led later on to people like Jeff Crystal, myself, Noah Davidson creating potential average yield. Now, what I love about all four of these dudes is I don't think you can tell the technical story without any one of them. I didn't just pick four, like because I wanted to do the Mount Rushmore. I picked four because it is these technical giants that created the concepts that we all base on. And then there was an individual who took it all together and became the greatest trader of all of them. And that was Jesse Livermore, who was not the greatest educator, not like these dudes, but he took it and knew how to run with it. Charles Dow showed that markets move in trends and that trends persist until they are broken. Wyckoff explained how those trends are created through accumulation, distribution, and supply and demand, associating certain degree of causation. Ralph Nelson Elliott revealed that trends move forward in waves and impulse and corrections rather than straight lines. See, Dow did not say things trend through patterns. He said they trend. He was talking straight lines. Nelson Elliott came in and said, no, 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 my friend. Markets move up, markets move down through a series of waves. Gann said, yeah, they move through a series of waves, but there's a specific timing and price to all of this that we need to master. And that is how I see technical analysis. And together, it is these grades that form the foundational principles of modern technical analysis.
I am geeked out on this. I'm ready, like the belief in theory. I learned so many things there. I learned so many things there. And Matt, like I'm just like having a foundation of belief on why technicals work and the theories behind it and what goes in. I mean, it's just
You
really
see why
cool.
I never, ever, ever, ever get off my belief in technical analysis. Like
Yeah,
there's not one thing anybody
there's a
can say.
foundation there,
Yeah.
right? There is a foundation and one really cool beard, right?
Yeah, a couple of them did.
Yeah, all of that. You ready to finish off the podcast with a quick game of thumbs up, thumbs down?
Yeah, of course,
All right.
100%.
I thought there were, because we rotate different things. I thought there were a lot of interesting upgrades and downgrades by analysts in the market this
Hmm.
last week. Like I thought there were some. In fact, there were a lot that I didn't even include. I had a lot to choose from, and so what I want you to do, and you can give me that thumbs up that you agree, thumbs down that you disagree, on the logic, however you want. Right? It's your thumb. You give me the thumb up, thumbs down, however you want. And we're just going to go
Depending
through.
on the stock, does it have to be a thumb?
No, it does not. You can give the middle finger if you want,
Okay.
if that's
I
what
just
you
want to make
were.
sure.
All right.
Sure. I won't do it, YouTube, so don't cut us off. But yeah.
Let's start with Microsoft, who received multiple downgrades from buy to hold by Stifel and other analysts tied to cloud AI competition and CapEx headwinds. CapEx headwinds is a very common reason to downgrade the big stocks. So Microsoft getting downgraded by
Did they
CapEx
downgrade in
headwinds.
the last 4 days?
All of these have been in the last week.
So they chased the downgrade then.
Yes,
They downgraded as we're nearing the 200 weekly moving average on Microsoft.
they did.
So they downgraded Microsoft, but DA Davidson upgrades Oracle for the same reasons.
Don't skip ahead. Don't
I,
skip
I'm
ahead.
sorry, I didn't know you were doing Oracle, but okay. I don't like. Yeah, technically this is a dog, and you got to wait on reversals, but if that's their logic, is we're downgrading due to CapEx spend. Microsoft wasn't even part of the CapEx spend conversation. It didn't like there was no ink spilled on CapEx spend on Microsoft. That was safe for Google, Amazon, and Meta. Microsoft was down because of the cloud Azure miss. And the amount of times I've seen in the 14 years of breaking down Microsoft Report and Azure, I can tell you right now, I've seen this song and dance out of cloud before. Microsoft's not giving up an edge on the cloud, in my opinion. They definitely have a lot of competition out of some of the other bigger dogs, but that's a bigger dog conversation. That doesn't explain what we're seeing in Mac 7 across the board. And so I'm gonna have to I'm gonna have to disagree with that. Like if you had a better rationale for the downgrade than just giving me your cookie cutter nonsense, boring CapEx bullshit, like fine. But no, I'm gonna disagree with that.
Amazon, DA Davison, who's going to come up a couple times here in
I
this
already
thing.
disagree with David Davidson. I don't know what they're doing, but
Down,
what they do on Amazon, like I have no
they
clue.
downgraded Amazon from buy to neutral last week on concerns AWS is losing its cloud lead.
Who are they assuming is taking over all of these cloud leads?
Apparently,
Is that part of the conversation? But if Microsoft's going to lose cloud and Amazon's going to lose cloud, like is everybody going to go to Google Cloud? But Google gapped down on earnings too. So, like I'm wondering, like, is everybody just going to not deal with the cloud anymore? Like, are we? This is kind of insane to me a little bit. By the way, I don't believe Amazon missed on cloud. They missed on EPS. They didn't have a great guidance report. I don't remember them. I'd have to dive into the earnings report. Um, do I agree with the downgrade on a nonsensical fundamental argument when I know damn well these people are just downgraded due to gap down due to earnings? Like if Amazon doesn't gap down and Microsoft doesn't gap down due to earnings, would they still be downgrading the
I
fundamental
doubt it.
nature of these companies? Or
I
they're
doubt.
just, which means they're chasing downgrades technically Always a mistake, always ridiculous. I'm going to have to disagree with that one as well. And by the way, I'm not suggesting pick up Microsoft and Amazon right now. Let these falling knives hit the ground, get reversals, but I'm just willing to bet that they're chasing downgrades here based on gaps on earnings that have absolutely nothing to do with the fundamental nature of these companies. So I'm gonna disagree with both Amazon and Microsoft's downgrade.
Now let's stick with DA Davidson for the last time in this, and let's go to that Oracle upgrade. Upgrading Oracle from
This is
neutral
astonishing. Who works at DA Davidson? What
to
is
a
going
buy,
on here? So,
believing that OpenAI will return
wow.
to its position as Google's top challenger and with a fresh stack of
Wait a second. Hold
capital.
on. Wait a second. Wait a second. The basis of the Oracle upgrade is OpenAI is going to compete with Google.
Yeah,
That's the basis.
that's what my notes say. I think the specific
The
quote is we
upgrade
believe.
is based on Sam Altman, excuse me, Sam Scam Altman. It's based on him. The dude, instead of saying we're going to win the race to AGI last year, said we're going to get everybody a porn bot. That dude, that's the logic behind the upgrade. Are they taking into account the 12% probability on credit defaults here out of Oracle?
I did that was not mentioned in the note to clients. The
Oh,
DA David
defaulting
analyst.
was not mentioned in the notes. Okay. Okay. Somebody's underwater, DA Davidson, trying to find some buyers to dump on your terrible stock. I cannot believe you scam Altman as the way to justify your upgrade on Oracle. This is insane to me. DA downgraded Amazon and Microsoft for cloud, and they upgraded Oracle because of scam Altman. Really?
Yep.
I knew a couple Davidsons along the way. My opinion has changed right now. Um, wow.
So
I'm honestly, I'm in shock. That was the logic. I'm gonna have to disagree with that one as well.
now this one is an interesting Palantir. William Blair lifted Palantir from market perform because all these analysts sometimes it's buy hold, sometimes it's perform outperform from market perform to outperform, emphasizing attractive valuation after a significant recent
Outperform
pullback.
general Nasdaq,
What outperform the
S&P.
general.
They're
Yeah,
usually
they
they're
usually tie.
usually anchoring against S&P. So the question is,
So
will Palantir outperform the S&P?
yes, citing more attractive valuation after the recent 30% decline, continued momentum in both government and commercial segments, and strong adoption of its analytics platform. Right, basically calling for about rebound here. Tougher one.
Well, it's tougher. I want to agree, but the 30% clip in price does not equate to a lower valuation. That's silly and nonsensical and doesn't understand how PE ratios work. Oh my goodness, I'm honestly just feeling so bad that normal people have to listen to these idiots. Like, I don't understand it. Like, these arguments are just nonsensical. Only makes sense if you have zero knowledge of an asset class, and that's what DA Davidson and these Wall Street firms are probably banking on. I just think I'm just shocked at some of the logic here. I'm hesitant on Palantir because I actually have a very positive opinion of the recent earnings report, notwithstanding the, sell down behavior following it. I thought Palantir had one of the better reports. They didn't make quick hits 2 weeks ago, but it wasn't due to the technicals. There was just better reports in general. But Palantir had a good earnings report, beat on EPS, beat on revenue, increased forward-looking guidance, and they actually gapped up, couldn't hold a bid. And so I'm gonna have to disagree just because of the technical conversation. I don't Software is going to have to kind of double bottom at that 200, and then I would say yes. Like, if software double bottoms at the 200 weekly, I'm an absolute yes on Palantir. but you just broke a major level of support. You're underneath absolutely everything. So I would have a hard time saying outperform from here. You go through proper reversal analysis, get a bull edge. I'm all about it. I have soured on Palantir a little bit just from a political perspective. Um, they got their greedy little fingers in the little things that I do disagree with, but I'm still a big fan of the company in general. And so I have the interest, but you'd have to develop really good. And I can't say it's going to, I can't say you're going to outperform the ES or the S&P 500 in general when you're riding the nine on the downside.
That's great analysis out of you. Maybe DA Davison and should hire you.
I couldn't work for that company
Last one, First Solar.
because I know they're analysts that are making those nonsensical arguments, don't believe in them, and they're told to make those nonsensical
Yes,
arguments.
we know how the game
So
works.
like no principles there, boys. Come on,
We
not
we know
zero.
we know how the game works.
Yeah, none.
Uh,
You're upside down on stock and you're trying to dump stock on the market. I know
last
you're
one
doing that for.
before we wrap up the podcast. First Solar downgraded by BMO Capital to market perform, so they had an outperform rating because it sees Tesla's push into integrated solar manufacturing as a real competitive threat. Tesla's plan to build significant solar module capacity over the next few quarters is thought to create a supply overhang, potentially pressuring module pricing. So basically, Tesla's getting into their area, and even after the dip, they're saying, nope, let's downgrade this to just a market
Yeah,
perform.
I would agree with that. Your the logic makes sense.
It's actually the
Like
first real logic out of all of
like
these where it actually,
Tesla made a major pivot where they're going to be focused on robotics and AI hardware. I'm certain alternative energy is going to be part of that. And so it that makes some sense. Who provided this analysis?
it was the analyst was BMO Capital.
I don't know them. Well,
They're
not
probably
bad though.
smaller
Not bad
shop
though.
trying to put out good.
Yeah, small shop telling the truth here. That's what's going on. But I would agree with the downgrade here. You obviously technically you're near the 200-day moving average. That's an interesting conversation on First Solar, most likely a post earnings conversation. But I would absolutely on anything testing the 200-day moving average like this, I would absolutely have as a perform with. Not you can't have the market bullish and your stock bearish and have the same ranking. So I would absolutely agree with that. And I actually appreciated the logic of the analysis.
Well, listen, brother, it's been I thought you were on fire this podcast. You brought some good stuff. I love the history lesson, bro. Really
Appreciate
do.
that.
Like it honestly just provided like this like surge of faith. Not that I didn't have faith in technical analysis, right? You can't be
Yeah.
around markets, as long as we have without developing that faith. But like just, like it's like, yeah, there's some cool stuff that it's built upon. There's some cool stuff that is built upon. But send us out, brother.
Yeah, if you love the podcast, best way to support the podcast is just to give us a nice little like and share on whatever platform you're watching the podcast on. If you're ready to become a pro member of Tackle Trading, you can always get a free trial there by hitting the link in the description below on our YouTube page. And while you're there, hit that live events page. Sign up for the AI Gold Rush next Tuesday. Going to have a tremendous amount of fun in the AI Gold Rush. And a week after that, on a Monday and Tuesday, we'll be teaching the February edition of Master Trader. Sign up for both. Great education coming out of Tackle Trading, and I'll see you there.